We have housing price inflation of 20% since she took office, including a 20% increase in land prices, which, of course, are not linked in any way, shape, or form to supply chains. Now, this mistake that she made against our warnings has great consequences, of course. Now, food prices are going to go up $1,000 this year. Because they can't afford homes, something the minister was celebrating a moment ago when she thought all of this asset price inflation was a good thing. And today her only defense is, well, it's great that the stock market is up. Well, sure. For the plutocrats, that is great news. Their assets have been inflated by the minister's excessive spending and money creation, as have millionaire mansion owners in her social circles. But for working class folks who can't afford stocks or houses or bonds or other things that she's inflating, all they've got
point of order,
is
Mr.
a
Chair.
real pay.
Is there a question in there somewhere?
No, that's not a point of order.
Yeah.
Come on.
Yeah.
We'll allow the member to continue.
Thank you.
So these sorts of mistakes have consequences. But I noticed that the minister used to defend her faulty prediction of deflation. She said that she was just relying on Larry Summers. Well, actually, Larry Summers made the same prediction I did, which was that deficit spending would lead to this inflation. I'll quote him. First, while there are enormous uncertainties, there is a chance that macroeconomic stimulus on the scale closer to the World War II levels than normal recession levels will set off inflationary pressures of a kind we have not seen in a generation. So if she'd even listened to a liberal economist who has been predicting that there would be inflation as a direct result of government spending and central bank money creation, then she would not have got us in the mess that she's created today. So would she agree with Larry Summers, whom she just quoted, that, in fact, deficit spending is contributing to inflation here and in the United States and in other places where governments have behaved similarly irresponsibly?
Mr. Chair, let me just start by saying that it's really important for Canadians not to be misled by a false narrative about where we are in the Canadian economy. And that is important because confidence, because people's attitudes have a very real impact when it comes to our future prosperity. Confidence, animal spirits, a certainty about where we are going in the future is a very real economic factor. And so it's really incumbent on me to correct the entirely misleading impression that Canadians are being given here, which is that somehow our economic policies aren't working and that somehow our country is not doing what is in fact the case, which is we are in the midst of a really strong recovery from a really dreadful external event. The external event was a global pandemic. Our government responded at scale and appropriately. The result is GDP growing robustly, jobs all are back, strong exports, and household finances in good shape. That is a good story, and that is what Canadians need to feel confident about.
Mr.
Thank you. That is your time, Mr. Poilievre.
With 0.3% economic growth. How could so much money buy so little?
Stephen Harper and the Conservatives added over $150 billion to the national debt with nothing to show for it. We made the decision to invest in Canadians instead, put more money in the pockets of middle class. And what did we get? 1 million Canadians lifted out of poverty.
We will be transparent about the results of our asset purchase programs. And we will continue to promote the use of plain language to help demystify our operations for interested Canadians. Ensuite, nous avons intensifié nos efforts pour mobiliser.
Second, we have stepped up efforts to engage with a wide variety of stakeholder groups beyond our traditional partners. Our goals are to reach Canadians directly and increase public knowledge of and participation in our activities in order to broaden understanding of our work and to build trust. A number of activities to engage the public are upcoming or already underway. These include an online campaign to involve the public in the 2021 renewal of our inflation targeting framework. And we have also just concluded a campaign inviting the public to nominate an iconic Canadian to be featured on the next $5 note.
Chair and Senior Deputy Governor. Oh, I have to go back to English, sorry.
Thank you very
Let me stop there, Chair, and Senior Deputy Governor Wilkins and I would be pleased to take your questions.
Thank you. And again, thank you both for coming, and thank you for those remarks, Governor Macklem. The lineup for the first 6-minute round will be Mr. Poilievre, Mr. Fraser, Mr. St. Marie, and Mr. Julian. The floor is yours, Pierre.
Congratulations, Governor, on your appointment. Your predecessor testified before this committee not long ago, and when asked about the possibility of inflation, something that many Canadians are worried about given that the bank has created almost $400 billion out of thin air in the last roughly 100 days, he replied that inflation would be a good problem because we know what to do if it arises. What would you do if inflation turns out to be higher than the central bank originally expected over the next year or two?
Governor.
I recognize that there is some concern about the extraordinary actions the Bank of Canada have taken. During the 2008-2009 global financial crisis, the U.S. Federal Reserve embarked on a aggressive strategy of quantitative easing, large-scale asset purchases. And at that time, there was concern that that would cause inflation in the United States. It did not cause inflation in the United States. In fact, it prevented disinflation and kept inflation reasonably well anchored on their 2% target.
Sorry, it's just that we don't have a lot of time. The question is, what if there is an unexpected rise in inflation? What would you do to combat it?
If there is an unexpected rise in inflation, and I don't anticipate that that's going to happen, but if that were to happen, we have all the tools, as Governor Poloz indicated. Well, we can raise interest rates.
There you go. Raise interest rates. Now, we have, as of 2018, according to the IMF, $3.56 of debt for every dollar of economic output in this country. That number is surely higher today. And that, of course, includes household, government, and corporate debt. In the G7 only, Japan is higher than Canada when you take into account household, corporate, and governmental debt. How much of an interest rate hike could the average Canadian household sustain before they would be unable to pay their mortgages or other credit market debt that they hold?
Just to interrupt for a sec, we will give you ample time to answer, Governor. We've got 2 hours here, so we'll give you ample time to answer. Go ahead.
Well, I want to stress that our focus is on supporting the recovery. The Bank of Canada has lowered interest rates to the effective lower bound of 25 basis points. We have embarked on a strategy of large-scale asset purchases, and that has a dual purpose, partly to restore, one purpose is to restore good functioning in our debt markets. The other purpose is to lower interest rates out the yield curve.
Sorry,
and we're very So,
Mr.
Sure.
Poilievre, the governor has at least 20 more seconds to equal
So,
your
you know,
time even,
for
and this is
now
a
and for the
crucial issue. So go ahead,
for
Governor.
now and for the foreseeable future, we're focused on providing the monetary stimulus and delivering low interest rates to support the recovery.
How
And
many
that is
households?
lowering the debt service costs that households face and companies and governments.
How many households would become insolvent with a 2 percentage point increase in interest rates?
Governor?
You know, these questions are extremely hypothetical. We have no intention of raising interest rates in the current circumstance.
Of course not. That's why I'm not asking about the current circumstance. I'm asking about the medium-term circumstance, sir. You've admitted that if inflation rises unexpectedly, that you would raise interest rates. Those were your words. You said that. And we need to, as Canadian parliamentarians, to know what that would do to households. How many would become insolvent if you had a 2% increase in interest rates?
The biggest risk to Canadians coming insolvent is not having a job.
Right.
The biggest risk to Canadians not being able to repay their mortgage is not having a job.
Right.
The government of Canada has delivered an extraordinary amount of support to help bridge Canadians through this. A monetary policy has lowered interest rates to reduce the interest rate costs that Canadians are facing.
All right. So
and that is the best contribution we can make to getting Canadians back to work, which is the best thing we can do to improve.
So, Mr. Chair, sorry, we're well over
insolvent
in the response time. So it doesn't sound like you have planned for the prospect of future interest rate hikes, and it doesn't sound like you've modeled out what impact they would have on households. I want to return to a paper you wrote in 1995 about government debt. And you said, in particular, higher debt levels require higher tax rates to be sustained, and taxes affect economic activity by driving a wedge between the price the sellers receive and the price the buyers pay. The wedge imposes an efficiency cost on the economy that is larger the higher the taxes are. In labor markets, for example, most studies find that the effect of higher taxes is to reduce desired labor supply, and the disincentive effects of taxation are larger the higher marginal tax rates are. In other words, higher taxes, less jobs. Higher taxes, less work. That's what you wrote. I'm wondering if your recent appointment has changed your mind and your perspective on this, and if you've reversed yourself in order to align with the high debt and high tax policies of this government, or if you've retained the view that you had in that paper.
Thank you. That'll end the questions. Mr. Governor, you have about a minute to answer. Go ahead.
Well, fiscal policy is the purview of the Minister of Finance. You know, what I wrote as an economist in the 1990s.
Or the Bank of Canada.
I stand by it. I stand by what I wrote. I would remind you, though, that the situation in the 1990s was very different. You know, in the 1991-92 recession, Canada had a very high debt situation, and as a result, the government was unable to provide the kind of stimulus and enforce. And of course, coming out of it, there was a large fiscal consolidation. Today, the situation is very different. We are reaping the benefits of starting from a very good fiscal situation, and the government is in a position to provide needed stimulus.
Taking into account the risk the market sees in making those loans. And you did say in your monetary policy remarks that there were challenges for the government in seeking borrowing. That I have the remarks right here.
Yes.
And it just does seem a little bit strange that you have to pump this enormous amount of money into federal government bonds. You're now helping at a rate of $250 billion a year annualized in bonds alone. And that doesn't include the 40% of the treasuries that you're buying. all of which suggests that the government cannot raise money on international lending markets at rates that it considers acceptable. And that's why you by definition, are creating it. If they could, they wouldn't need to come to you. So I just respectfully challenge the notion that you and others have put forward, that governments can continue to borrow at this rate and at the rates that they have been without any consequences. And I turn the committee's attention to the overall indebtedness of Canada, because the economy has to support household, corporate, and government debt. So the question to you then is, how much debt do Canadian households, governments, and businesses owe combined?
That's the question. Well, we would normally measure that in terms of ratio to GDP, which we know for the household sector is around 100, give or take. I'm gonna have to get the exact facts to you, but off the top of my head, it's approximately 100% of GDP. It's like 170% of disposable income. That's usually the metric that we refer to from a household sector point of view. The corporate sector, I don't have that on the top of my head. And then the government of Canada is about 30% of GDP, as we know. And provinces are larger than this as a share of GDP. So
the combined indebtedness of Canadians is multiples of our entire the entire size of our Canadian economy. Another good reason we should reject the notion that we can just keep borrowing and borrowing. Eventually, our economy will not be able to support the abundance of debt that is being piled up here. Now, moving to provincial debt, to which provincial governments have you had to come to the rescue so far, or do you expect to have to come to the rescue in the immediate future?
And Governor, you didn't quite complete your last answer there. If you want to take the time to finish the answer, do so.
I'm not sure out of all of these comments which ones I should treat as questions, Mr. Chairman. But I will go to the last question. I guess I can say that we have not come to the rescue of any provinces. We have been buying short-term securities from the market, directly as the provinces have been issuing, as a form to add extra liquidity to the system. As I was saying before, the strains that we're looking at are not strains related to borrower strain. The strains are that across the entire network or the entire system, everybody is, in times like this, goes to more liquid positions. That's when they're selling their stocks, when they're selling their bonds, when they're adjusting their positions, just when they're drawing their credit lines. A firm that has a committed credit line with their bank several weeks ago would see the trouble coming and drew their credit line right to the maximum and then just parked the money. Well, the banks have to fund that in some way. They don't just pull it out of their vault or their deposits. What they do is they go to the market to fund that. And those markets were jammed up because of so many people throughout the economy, and I'm talking about people acquiring additional liquidity. And so it's the central bank's job in that situation to provide those needs. And the way we do that is by acquiring the assets, the illiquid or relatively illiquid assets that the market is providing up. And so our balance sheet expands at that time, which is what central banks do. And then at a future time when those tensions ease back, no one will need the liquidity. The firm that drew its entire $100 million credit line will put the money back, pay back that credit line, then the bank will have all that money to put back out into the market, and that's when those assets get reabsorbed. This is how a liquidity provision takes place.
Okay, thank you both, and thank you for that explanation, Governor. And we will turn to Ms. Zerowitz and then on to Mr. St. Marie. Ms. Zerowitz.
Thank you so much. I hope everybody can hear me. I just want to say a huge thank you to the Senior Deputy Governor Wilkins and to you, Governor Poloz, for presenting to us today. As this is, as you mentioned, the last time before our committee, I want to thank you for your extraordinary service to Canada, and I want to thank you for your leadership during this pandemic. Governor, over the course of the last month, you've taken some very significant measures to ensure that the financial markets in Canada continue to function and that credit remains available. I know you've adjusted the overnight rate a number of times and that you've introduced a number of programs to increase liquidity in core funding markets, and you've taken us through that today in your presentation. Yesterday, as you mentioned, you did present your monetary policy report as well as you announced some additional support. So in my riding of Davenport, they're like many constituents or most constituents across the country. They're worried, they're stressed during this pandemic, and they're wondering whether life will ever go back to normal. So my question to you is, what should our constituents think about your announcements? What signal are you sending to them? What are you trying to say to them?
Well, I mean, the narrative, of course, is you're right. It is every good reason for people to be concerned. And our job is to do everything we can so that they needn't be. But I'm going to ask Ms. Wilkins to walk you through our economic scenarios in just a moment. But let me just say that the comparisons that people are making to past episodes are actually, in most cases, quite unhelpful. This is a very unusual thing. It's closest, I think, to a natural disaster. And what we are doing with our policies is finding various ways, essentially, to stop the clock so that we can wait out the pandemic and then restart the clock. And what happens is, in the interim, especially fiscal actions put a floor underneath people so that they're supported through that period, so they have a bridge to normalcy, and that forms the platform for the recovery afterwards. And so people should be reassured that we're using all the tools in our toolkit in order to provide this transition. Carolyn, would you like just to talk briefly about the scenario? We don't have a forecast, but a scenario to explain how it comes together.